Is your rate of return real? You know, your future is riding on you knowing the answer to this question. So by the end of this video, you'll know what's most important when it comes to calculating your rate of return on your investments and how to apply this knowledge to your future planning. Hi, I'm Matt Kennedy, the founder of Kennedy Wealth Design and the author of the best-selling book, Untapped Wealth. I specialize in working with entrepreneurs and business owners and high-income professionals, helping them increase their cash flow, decrease their taxes, so that they can have a better life, a better business, and a brighter future. Understanding the difference between math and money is crucial when it comes to retirement planning. So here's the question that I want to ask you right now. If I could put you in some type of investment fund, stock, something like that has averaged 25% over the last 4 years, would you be interested? Most of the time people say, sure, absolutely, 25% over the last 4 years? That sounds great. Well, what if that investment actually looked like this? The first year, let's say we put $100,000 into this investment. And the first year we get a positive 100% return. And so now your account balance is at $200,000. You open your account statement and you say, gosh, Matt is fantastic. He sure is great at picking these investments for me. And I'll certainly take those accolades. But then year two comes around and it's not so good. In fact, we have a negative 50% return. So we end up losing the $100,000 that we gained, and our account balance is back to $100,000. You call me up, you're not so happy, but hey, you haven't lost anything yet. And I say, hey, just stick around in the investment. Let's see what happens. Next year, you get a 100% return again, and now you're back up to $200,000. I'm back in your good graces. But then the fourth year, you got a negative 50% return. You're back down to $100,000. You call me up and you say, hey man, I thought this thing was going to average 25% over a 4-year period. And I say, well, it did average 25%. Look at our annual returns. We did 100 minus 50 is 50, plus 100 is 150, minus 50 is 100. Divide that by 4 years, and we get our 25% average rate of return. That's the math. But what's our actual rate of return? Our actual rate of return is 0. That's the money. Money and math are two different things. Now let's look at it in terms of actual market performance and what that might mean for your money. Notice here that I have gone back and I've taken the returns of the S&P 500 from 1999 to 2018, so over the last 20 years. And using our math method, meaning taking all of the annual returns, adding them together, and dividing by 20, the average rate of return over that time frame is 7.16%. But then when we go to the money column and we look at if starting with $1, what would that dollar grow to? Our actual rate of return, once you count the negatives and digging out of the hole to get positive again and all of that, our actual rate of return over the last 20 years has been 5.62%. Now, that's quite a difference. That's almost 2%. Let me show you how that might affect your retirement planning moving forward. Let's assume we're contributing $100,000 a year over that 20 years into the S&P 500 or an S&P 500 fund. And our annual interest rate, we'll use that average interest rate of 7.16%. That means our retirement account would grow to $4.4 million. So I'm going to write that in here, 4,470,595. Okay. Now let's change some things. Now let's use our actual rate of return, which was 5.62%, and see how that affects our retirement account balance. Drops our balance. Drops our balance to $3,000,000 $730, $256. For a difference of, notice up here, here's my 4.4 million minus the 3.7 million, for a difference of $740,000. That's $750,000 no longer in your account. So if you're assuming a 7% return in your retirement planning, but you only get 5.62, that's almost $750,000 less in your retirement account. Now, when we're talking about retirement accounts, as you know, Kennedy Wealth Design, we want to talk about cash flow, not just balances. So let's look at what that balance might produce for us to find out exactly what we're losing. So notice here, I've just created a quick little spreadsheet to show you $740,000 going into an account. That's the difference between what our accounts would have grown to given those different rates of return, the 7.16 versus the 5.62. And if I did a 20-year spend down, meaning I spent all the money over 20 years and had a 5.62% return every year, that's $62,000 per year over 20 years that I would lose from my retirement income. That's $5,000 plus per month, that the difference between our average return and actual return actually cost us out of our retirement. So it's very important to know as you're planning for your future, are you calculating, or is your investment advisor calculating your returns based on average returns or actual rate of returns? Meaning, are we just using math, or are we actually looking at money and how the returns, the negatives and the positives affect our money? You know, I find that most folks that I sit down with are losing between $1 million and $2 million over their lifetime, and they don't even know it. The reason that they're losing this money is simply because their financial decisions are not coordinated. To learn more about what we're talking about and about our unique planning solution called the Integrated Wealth Cycle, just click on the Show More tab below this video and then click on the link to take my masterclass. And also you can there apply to become my client. Thanks for watching, and be sure to subscribe to our channel and click on the notification bell so that you'll be notified every time we post new videos.